Good Wednesday afternoon, everyone. Kip Harrods here with your daily midday investing update here at the VRA. Hope you're all doing well. Hope you're having a good morning, good early afternoon. We had a great open this morning after a bit of a rocky day yesterday. Really strong open this morning, and now the Dow's down 330, just off the lows. Dow's down 330, Nasdaq's down 142. Semis are leading the way down 2%. That's not what you want to see. So you have to ask yourself, what changed? What changed? Well, here's what changed. Last night, on his show on CNBC, Jim Cramer, the Nazi Jim Cramer, most of you know why I call him that, he recommended that everybody be forcibly, in America, everyone be forcibly injected against their will with the vaccine, and that the U.S. military be used to force the injections, to give the injections. That's the Nazi, the fascist, Jim Cramer. I will never let him forget that, especially now that we know what's in these poison jabs. Jim Cramer on the show last night came out and said that, hey, bull market's back. We're going to have a great summer rally. Jim Cramer is one of the worst market timers ever. As you may know, he's beaten the markets. I think this is right. I think he's beaten the markets twice out of the last 19 years. I think that's current. And obviously, portfolio is being destroyed year after year after year. So when Jim Cramer says be bullish, the smart money says it's time to be bearish. Now, I wrote that to our clients this morning, a little tongue-in-cheek, because it wasn't actually Jim Cramer, the Nazi, saying this. It was actually a guest he was talking about, a technician named Larry Williams, who actually is a pretty good technician. Larry Williams, not Jim Cramer. Larry Williams is looking for a big rally this summer into July, August that should take the market sharply higher. I think Larry Williams is right. I don't really pay attention to anything Jim Cramer says. But the point is made. He is the kiss of death. Jim Cramer is the kiss of death. So we have to deal with that today. Also today, something else happens in addition to the Nazi coming out and giving his kiss of death. The Federal Reserve today begins quantitative tightening. Now, it's tiny. It's very, very tiny. They're not actually selling bonds right now. What they're going to do is let them roll off, okay? Meaning they're going to mature and they're not going to reinvest the amounts, okay? So that's quantitative tightening light. It's really not even quantitative tightening, frankly, but that's how the markets look at it. And it's a small amount. It's $45 billion a month. That'll continue till September when it basically doubles in size, and they'll let more bonds roll off. So it's a very, very tiny beginning. But history is pretty clear on this. And if we didn't have so many other reasons to be bullish here, and we do, I'll talk about those more in a moment, I would be concerned about this because the history is very clear. Since quantitative easing began in 2008, 2009, it actually started in Japan in 2001. When it started here in 2008, 2009 for the financial crisis, you look at the charts and it's really clear. The time to be long stocks is when quantitative easing is going on. The time to be short stocks is when quantitative tightening is going on. And obviously we're in that now. So that's a negative. It's something we have to deal with. I think outside of, Joe Biden, Team Biden, and the intentional destruction that they're forcing on Americans, okay, and the world really. Outside of that, quantitative tightening would be my biggest concern. But let's look at the flip side now. The market has already had a bear market. Again, most stocks down 50% in the last year. We talk about this often. The sentiment surveys have gotten so bearish, you must be bullish, okay? Tyler talked about yesterday in his podcast. Pretty good fact. When the AI sentiment survey falls below 20% bulls, and it's only happened 10 times, the rest of the next year has been up 100% of the time with really good gains, like 13% gains over 6 months, better than 20% gains over the next year. And that's not the only indicator that says we're going to have a big move higher. Remember, this is one of the worst starts of the year that the S&P 500 ever had. It's one of the worst 4 starts. And the other worst starts, okay, the market's been up after a terrible start in the first 100 days. The market then has soared higher, again, 100% of the time with really good gains of about 19% over the next year. So we've got a lot of analytics that point to higher prices. But look, we just had a brutal bear market. This is not going to be straight up. And that's what it is. But we also have other things to look at fundamentally, okay, that I think, as we wrote this morning, are a difference maker. PE multiples, price to earnings multiples, they were for many years they were higher than average, at least 23, 24, 25. Nothing like the dot-com era. Remember, during the dot-com boom, the PE on the S&P 500 got to 46. right? And there really wasn't a PE multiple on tech stocks because they didn't have any earnings. They just had a high price. But again, 46 PE. So we're not, anybody that told you that we just had a run similar to .com is really uninformed because we didn't. PE multiples again, 24 here about the high, 46 in 2000 at the top. So now let's take a look at them. Right, we've had this big correction, big bear market. Let's look at them now, both in U.S. and globally. In China, the PE multiple now is below 10. Okay, hard to trust China on anything. I think it's an uninvestable market, but it's still the lowest PE multiple they've had in many, many years. In Europe, much more dependable. Also, again, it's a socialist, completely socialist setup. Very hard for companies to make money. So that's why they have a lower PE multiple, and they always will over U.S. stocks. But still, their PE multiple now has shrunk from what was last year 18 to now 12 and a half. Okay, the PE is 12 and a half in Europe. And the U.S., the big market, of course, when we care about most, big strength there as well. Again, we're down from a 21 last year to now a 17 times price to earnings multiple. So again, now we're getting back to reasonable PE multiples, even cheap, based on growth. And again, we expect earnings to be very strong this quarter as well and for the rest of the year. More importantly, and I think this is significant because, we focus here a lot on Cathie Wood's ARK fund. Again, down 77% from the highs, brutal bear market. We think those lows are in. That represents, I think, the new bull market, right? Their innovation stocks in Cathie Wood's fund is more like the modern day .com kind of an internet tech stock. But for small caps themselves, we're now back to price earnings multiples, okay, that we've seen only at the very lows, okay, in past markets. We're at the same level now we were, for example, in the 2008-2009 financial crisis as far as PE multiples for small caps, Russ 2000. And also at the same levels we were at, actually a little bit lower than we were at during the depths of coronavirus insanity. So this sell-off has righted a lot of wrongs. It's made a lot of expensive markets not so expensive and actually now cheap, especially again for small caps. So there are a lot of reasons I think to be bullish here. Again, the internals aren't good today, by the way. We're looking at 2 to 3 to 1 negatives across the board. Still nothing like what we had seen. But again, when you've been through what we've been through, when you see the Dow right now as I speak is down 380 points, Nasdaq down 171. Again, this gets your attention. We still think the lows for most stocks are in. It won't be straight up, and you got to take the good with the bad. And Jim Cramer, man, just don't make these big calls. Just stay bearish. Jim Cramer, please stay bearish so we, the rest of us, can make money being long. Have a great day, everybody. Always appreciate you watching. Join us at the close for our VRA Investing Podcast. Thanks again. Have a great day.